If you want to buy land and build a custom home, then you need to know the difference between a local bank and our one-time close construction loan. Let's talk about the local bank first. So let's think when we go local bank, you're going to normally do 3 loans, okay? First up is going to be your land loan. So they're going to tell you when you go to the local bank that you need to go find your land. Once you find your piece of land, you'll go under contract and you will do a land loan with them, okay? That will normally require at least 20% down is typically what I would see. All right, so let's just say, for example, you're buying a piece of land that's $100,000. So you would need $20,000 to buy that piece of land, and that's not including any closing costs that you may have, etc. Okay, so you bought your land, $20,000 down, now you have your land loan. Now you're going to go get with your builder and you're going to essentially come back to the bank in order to do a construction loan. And then they're going to say, we need another 20% down. So let's just say the builder says, okay, it's going to cost $400,000 to build this home. And you have a contract with that builder. So that local bank is going to say at that point, okay, we need $80,000 for your down payment for your construction loan. All right. And typically that's not all. A lot of times a local bank, again, everyone's going to be a little different, but typically a local bank is going to require you to deposit what they call a contingency reserve. This is just an added reserve that they typically will want you to set aside separate from your down payment that's there as just in case, okay? It's there in case the builder goes over, you need added funds, etc. And that has to sit in that account separate until the home is complete. And then if you didn't use it, then you get it back. But it still cost you. That's money that's got to sit in that account. A lot of times the bank will also require a 10% contingency reserve in addition. So on that example, $400,000, you need $80,000 for your down payment to close on that construction loan, plus an additional $40,000 sitting in that account for that contingency reserve. So now you've got your land loan, you've got your construction loan, you're essentially $100,000 into it with your down payment plus another $40,000, you're at $140,000 that's out of your pocket to close on that loan. Now your house goes up, you get built, and then you go back and then you would refinance with that bank and roll the construction loan and your land loan together in order to close into your permanent mortgage. You move in and then you start making your payments. Now let's talk about a one-time close construction loan and how that is different than the local bank. First of all, like the name would suggest, you're only closing one time on all 3 of those: the land, your construction, and your permanent mortgage. So one closing for all